Welcome back. Now let's talk macros. This is, of course, the pre-budget special, and we're talking about how the market is looking at Budget 2017. Cautious on short-term growth, firm on fiscal prudence, and positive on the impact of demonetization. That, in essence, are the key highlights of the economic survey tabled in the Parliament on the eve of the Union Budget. Lata, you've gone through the highlights of the document, and what's your reading of it?
Well, it is 14 chapters and 335 pages, so I haven't gone through all of it. But for what is relevant to the market, the first part is that it has given you an estimate of GDP which is lower, and that's important because that will have ramifications on how much tax growth you can expect. This year's growth itself is more likely to be 6.5 to 6.75%, it says, and in nominal terms that will come down to about 10.75%. You know, the earlier assumptions were 11.5% nominal growth. Next year's growth again will not be this runaway 11.5%. It will be more likely 11.25. In real terms, it will be 6.75 to maybe 7.5 in the best case scenario. So what does this mean for market participants and for those who are watching the budget? It will mean that you cannot assume a very high tax growth. So the number that we will watch out for is what is the GDP growth that the budget is assuming, considering that the survey is talking about growth being moderated by demonetization. The second thing is the fiscal deficit. The survey is repeatedly saying that fiscal activism like of the Trump variety, you know, where I will make the government spend more, works in countries like the United States. It may not quite work in India. So that is hinting perhaps that there will be fiscal discipline in the budget as well. Now this year's fiscal deficit is 3.5, and by an older timetable of an older FRBM panel, it should go down to 3% for the next year. So that is a number that the market will watch out for. If it's 3%, they'll be very happy. But it's not just 3%. What is the tax growth assumption behind that 3% fiscal deficit? If it is an unrealistic, maybe 20% growth in taxes, 18%, maybe the markets will not be very happy. Maybe if it is 12%, because you assume nominal GDP growth lower, you should assume lower growth in taxes. As well, the survey tells us that the universal basic income scheme, which was mooted by several people in government, is an idea whose time has come for discussion. It is not an idea which can be implemented immediately. That will come as a big relief for the market. Nevertheless, we will watch out for whether there are any fiscal giveaways. Is the tax being spent on capacity increases in roads and rails, or is it just giveaways to certain economically backward segments, in which case its end use is immediate consumption. It is not an investment into a better tomorrow. So these will be the issues that the economic survey flags off, and we will watch out for in the budget.
All right, so let's see what actually comes in the budget. But let's get you some voices as well. Will demonetization have any influence on the government's fiscal roadmap? Let's hear out what economists and policymakers expect with regard to growth and fiscal targets.
I think we're seeing evidence, on the ground that, the situation is improving. Obviously, it's had some impact. I don't think one can question that. But how long it's going to last is really the judgment that has to be made. And so if it is a temporary shock, then to respond to it with what might be a longer-term sort of fiscal commitment may be dangerous in terms of, reviving inflationary pressures and so on. So I think we've got to be a little careful about how something like this is responded to. If it's a temporary shock, you cannot respond to it with permanent measures. And I don't think the implication of this is that the fiscal consolidation strategy should change.
I personally am hopeful that in terms of that trade-off, there will be some enhanced expenditure on public investments as opposed to it being frittered away on things that are slightly short-term in nature.
Three things I would look for to call it a good budget would be a clear plan to improve the tax GDP ratio, to simplify corporate taxes, to continue with the process of business process reforms to improve India's doing business indicators, deliver financial sector reforms, deliver tax reforms, and also to manage expenditure more efficiently and effectively on part of the central government.
Okay, that's Ratin Roy, who's also a member of the FRBM panel and someone who believes that fiscal prudence is important. Well, That's from The Economist. India Inc., on the other hand, is hopeful of a reduction in corporate taxes. In the budget, it also expects some measures for creating jobs and accelerating investments. Here are some of the prominent voices and what they expect from the budget.
We need to admit that no matter how we put it, the economy currently is somewhat dislocated, okay, because of demonetization. Whether it is right, wrong, indifferent, but it is somewhat dislocated, and the budget has to bring it back on track. Okay, that's for sure. What does that mean? Consumption, investment. If we can get consumption right, investment right, it's always the case, nothing new, but this time more so than ever before. To create a positivity about taxes. Okay, and I say that very carefully because we know that only 1% of Indians pay tax, 99% don't, right? So whether you lower or increase the personal taxes, it's only affecting those 1% people.
The Prime Minister already in his New Year address announced a whole host of initiatives which one would have expected actually in the budget. The expectations are that the big significant part of this will focus on taxation.
I think this year the budget is going to be different because there has been an event which has happened, which is a significant event, which has, I think the psyche of the nation has changed a lot. We have moved to digitization in a big way. And there are a lot of changes which has happened around us, the consumers, the cash. I think behaviorally, psychologically, the changes are quite huge. And government has to work on something to, there would be some slowdown in the recent days. But government will have to kickstart the economy by giving a lot of boost to us and to the digital payment business. So we expect a lot to come in this budget. I think our cost of doing business has to go down and our transaction cost has to go down, and that's what we expect.
Biggest desire from the budget and from policy in India is how do all of us work to dramatically increase jobs. The biggest challenge and opportunity for us in India is to be able to create jobs. And therefore, a boost by government to business, which creates jobs, should be the bedrock of India's policy.
Quint credit.
All right. On that note, let's move on. Now, what are the key stocks to watch out for as we get set for the budget? Well, the man who always has his pulse on the market, Varinder Bansal, is here with that extremely critical detail. So, Varinder, what are the stocks on your list?
Well, thank you so much. No prices for guessing that the most important stock could be ITC. But, you know, the GST will be implemented by the mid of the next financial year. So, you know, the hope is that the excise duty this time will be less than 10%. And that could be the case. And that will be positive for ITC. ITC was up 1% before even, you know, the budget commencement. Also, if it's over 12 to 13%, that will be bad for ITC. In any case, you know, the other high expectation this time is that there could be a cut in cess for upstream companies like ONGC and Oil India. And remember, the current rate is 20%, and the expectation is that that could be brought down to 10%. If that happens, that is very, very positive for ONGC. The EPS could go up by nearly 16 to 17%. So there could be huge gains for ONGC tomorrow if the cess is actually reduced. Cut in excise duty on fuel. Government has already taken 9 rounds of excise hike. So if the cut in excise comes in, that could not be positive news for the OMCs like HPCL, BPCL and IOC. There is a huge expectation that there could be higher import duty on domestic agrochemicals. If that happens, all the domestic producers like Rallis, PI Industries, Dhanuka Agritech, UPL, they could benefit. Corporate tax cut by 1 to 2%. Now again, this is one big expectation this point of time. All the sectors which don't take any tax benefits and which are not being phased out and all, you know, sectors like media, real estate, consumers, housing finance companies, stocks like Z, DLF, Indiabulls Real Estate, DHFL, these are the sectors which don't take any exemptions. They could benefit a lot, and you will see, you know, the EPS upgrades by 4 to 5% on most of these companies. Housing finance companies, again, huge expectation that the tax exemption could be raised from 2 lakh to 2.5 lakh rupees. If that happens, you will see, you know, stocks like LSE Housing Finance, DHFL, their EPS being moved up by nearly anywhere between 3 to 4%. If that additional 50,000 hike comes in, fertilizers, you got to watch out for the subsidy. Currently, it is 70,000 crores. If it is being raised, that means there is more subsidy amount for these fertilizer companies. That will be important to watch out for. Ashok Leyland, if there is an announcement that there could be, you know, anything on scrapping of old commercial vehicles, he is the largest player, and that will benefit Ashok Leyland. PSU bank recapitalization, not much expectations. We all know that 10,000 crore is allocated this year. So if there is any amount higher than 10,000 crores, that will be good news. Universal basic scheme, if it comes in, and if there is also an announcement that could be reduction in subsidy, then probably stocks like Hindustan Unilever, all these bigger consumer players, Godrej Consumer and all, will benefit from that. PSU dividends also keep an eye on the higher dividend which the government receives from all these PSUs. That has been the case since last 2 or 3 months. And the non-tax receipts, that item could be important to watch out for. Whether the government will go for more and more divestment of all these SIC units, the land parcels and all these ITI, MMTC, STC could be important to watch out for. We heard about IFC as well, so keep an eye on that. Airlines, if the service tax on airlines, the ATF is increased in line with GST, that could be negative for airline companies. And of course, the renewable energy stocks, the housing for all stocks, leather and all these export-oriented companies, textile companies, they always are in fashion when we hear about budget. But the most important one will be ITC, ONGC, Oil India, agrochemical stocks for me in the budget.
Okay, that's practically the entire universe of stocks. Yes, oil exploration stocks, agrochemical stocks and housing finance companies. That should be top on your agenda if you're an investor. And that's it on this special edition of Countdown to the Budget. Thanks for watching.